Good morning, students. Welcome back to the Cost and Management Accounting session. And good morning, all of you. Good morning, Ganesh. Good morning, Sushil. Good morning, students. So we'll be starting with the last module, Budget and Budgetary Control. So I hope you must be having your cost accounting sessions, and you must be practicing the cost accounting concepts and a lot of numericals, I'm sure. So we'll take it forward by budget and budgetary control. So let's start. So what exactly is budget? See, budget is an instrument, it's a statement, all right, where we exercise, it's basically a part of planning. So budget is a planning, from the management point of view. So planning, then we implement the budget. And yes, the most important part is that budgetary control. So what all we planned, what all we executed as per the plan, any deviations, any differences from the plan to the implementation, we basically take the control measures. So budgetary control is an extension of the budget, and budget is a part of the whole process of budgetary control. So budget is an instrument of management used as an aid in the planning, programming, and control of business activities. So it starts with planning. All right. So what we plan, and then what we execute or what we implement, and then we control the deviations if there are any. So budget is a financial or quantitative statement. So it's all in figures, all in numericals, prepared and approved prior to a predefined period of time of the policy to be pursued during that period for the purpose of attaining a given objective. So budget happens before the actual period of time, before the real time. So budget is a planning phase. All right. Suppose we have to plan for the next year. So budget will happen today for the next year. So for a given point of time, we plan before that in advance. That is budget. All right. It may include income, expenditure, and employment of capital. So the budget is a blueprint of the projected plan. Why projected? Because we make a plan of the future. That's why it's a projected plan of action expressed in quantitative terms for a specified period of time. So for a future period of time, for the next year or the next quarter or the next month or the next 2 years, whatever the plan is, the budget is prepared in advance. That's why it's called a planning. And when we make a budget, then we implement it. So on the basis of the budget, the management objectives are charted out in the budget, and then we implement the budget. And then we see when the actual time comes, when we see why the actual cost or the actual income is any difference between the planning and the actual, then that is called a deviation, and then we take control measures, that part of budgetary control. All right. So budget is basically the statement which we make, the forecasted statement. Budgeting is the process of, now it is the whole process. So budget is what we make, and budgeting is in where we make the budget. So budgeting is a process of designing, implementing, and operating of budget. So the whole process of making the budget, designing the budget, how the format should look like, what all information should be there in the budget, that is the whole process of designing and implementing. Of course, after the budget is made, then we implement the budget. Whatever cost and the units and whatever the weights or whatever is included in the budget, we try to implement it and we operate the budget. The main emphasis in budgeting process is the provision of resources to support plans which are being implemented. That's the most important objective actually of a budget. We have planned how many, let us say, production we want to do in the next year. So on the basis of that production, we need to plan the capital. We need to plan the resources which will be required for that particular production. So if we want to produce 10,000 units next year, that is the budget. Now for those 10,000 units, we have to plan, we have to employ the resources, we have to make arrangements of capital, all the resources, labor resources, material resources, all those setup, the factory setup, the machine setup, the whole administration setup has to be done. for implementation of the budget. So budget helps us to plan the resources, the employment of capital. That is the purpose of the budget. So that, there should not be an emergency situation that, okay, this much production is required, this much capital is required. We should arrange the capital in advance. If we know in advance that, okay, this much units of, production or output has to be there in the next year. So it's easy to plan, it's easy to arrange capital, it's easy to arrange resources, it's easy to arrange the whole setup for that implementation of the budget. It is a means of coordinating the combined intelligence of an entire organization into a plan of action based on past performance and governed by rational judgment of factors that will influence the course of business in future. So it is the whole organization is a part of it. It's not that one single department has to do it. Every organization, the entire organization, all the departments in the organization has to contribute towards the planning phase. That is the budget. All right. So it's every department will give the inputs. Okay, this much. And what inputs actually every department has to give? Every department has to give the inputs based on the past performance. Last year we did 20,000 units of production. Next year we can give 40,000 units of production. So that will come from the production department. Raw material department, the inventory department, the stores department will give the information, the inputs that, okay, this much raw material will be required. This type of raw material will be required. This much quantity of raw material has to be required. This quality of raw material has to be required. So raw material department, stores or inventory department will give the information. Then the purchases department will give the information. This much time it has to take to fetch the raw material from the supplier. So it's a contribution, it's a participation of the entire organization and not a single department. All right. That is the whole budget is all about. Essential steps for preparing budget. Now, this is something very important. Firstly, organizational structure must be clearly defined and responsibility should be assigned to identifiable units within the organization. So if the raw material department or inventory department or the production department is give the inputs, so the production budget, the raw material budget, every department has to basically assign the responsibility of it, of implementing and thereby the control. All right, they are answerable for all inputs they have given for the planning phase. Setting of clear objectives and reasonable target. Objectives should be in consonance with the long-term plan of the organization. So everything, the budget, everything should reflect the objectives of the organization as a whole, the objective, the vision of the management. Budget is a reflection of the vision and management of the organization. Budgets are prepared, objectives and responsibilities should be clearly stated. So every department, every person, whether individual or a group, has to be assigned a responsibility for it and communicated to the management or person responsible. So whatever is the responsibility given has to be communicated also, then only they will be answerable. Budgets are prepared for the future period based on expected course of action. So budget is all based on the forecast made. All right. Budgets are updated for the events that were not kept into mind. So, but there has to be some flexibility in the budget. If today I'm making the budget, after 6 months, some scenario changes. Let us, for example, COVID comes. All right. So last 2 years has been a havoc basically in the organizations. So many unexpected or unavoidable circumstances come. So budget, there has to be some extent of flexibility in the budget so that we can update the budget according to the circumstances which were not foreseen when the budget was made. All right. So as and when the circumstances change, the scenario changes, the economy changes, there should be changes in the budget as well to make it more updated, to make it more realistic. All right. Why we do it? Because to minimize the deviations between the budget and the actual scenario. So budget should be updated as to as much extent as possible. Budget should be quantifiable and master budget should be broken down into various functional budgets. So we'll be learning a lot about what all the functional budgets and how they're prepared. Budget should be monitored periodically. Variances of the actual outcomes should be compared with the actuals, and variances analyzed and responsibility should be fixed. So whatever budgets we make, we compare it with the actual outcomes, actual cost, actual production, everything, whatever happens, the actual scenario, and then the variances are analyzed and responsibilities are fixed. Budgetary performance needs to be linked effectively to the reward system. Of course, when there are a lot of deviations coming from the responsibility centers, then of course there has to be, let us say, the budgeted cost, the actual cost are much less than the budgeted cost. So it's a favorable response from that particular department or that particular individual. So the person should be rewarded if the actual cost, or there is a saving in the actual cost. All right. Let's move forward to budgetary control. So it is a system of management, control, and accounting in which all the operations are forecasted and planned in advance to the extent possible in actual results compared with the forecasted and planned results. So budgetary control involves very important 4 points: establishment of budgets. So, the most important thing is there has to be the budget first. So the budget should be prepared first. Continuous comparison of actual with budget for achievement of targets. So once the budget is prepared, then the actual scenario happens, the actual period of time for which the budget was made. So that actual time has come. Now actual cost will be incurred, actual expenses will be incurred, and then we compare the budget with the actual. So what all we planned and what all now it has become, or it has incurred, or it has occurred. Then we compare both the budgeted and the actual scenario, and then any differences, any variations, we just analyze all the variances. Revision of budgets after considering the changes in the circumstances. Fixation of the responsibility for failure to achieve the budget targets. So this is whole about the budgetary control, which starts from the planning, then moves to the implementation or execution, and then the control of the whole system. All right. I hope any queries so far? Good morning, all of you. Good morning. Okay. Master budget, Ganesh, is I'll be explaining you all types of budgets. A lot of budgets we have to do. So we'll be starting with the budgets, and then I'll explain all types of budgets. Don't worry. Components of budgetary control system. So there are different categories under which there are different domains under which the budgets are categorized. Physical budgets. Physical budgets are those budgets which contain information in quantitative terms, such as physical units. So budgets, under physical budgets, they are made in units. All right. How many units to be produced? How many units to be purchased? How many units to be consumed? So it's all in units. They may include quantity of sales, like the volume of sales, how much sales we can make in units. Quantity of production, how much output is expected next year. So quantity. Inventories, how much quantity of raw material is expected to be consumed, how much quantity of raw material is expected to be purchased. So in units. Manpower budgets are, all those are physical budgets. How much number of employees, how much number of skilled or semi-skilled or unskilled labor is required. So all these are in numbers and the units. They're called physical budgets. It's the category. All right. Cost budgets, which provides cost information in respect of manufacturing, administration, selling, and distribution. So their cost budget, how much administration cost is expected to be there in the next year, how much manufacturing cost or selling and distribution cost is expected to be incurred in next year. So it's the cost or the overhead budgets. Manufacturing cost, selling cost, administration cost, research and development cost. These are all the cost budgets, which will give you the projected cost for that particular given period of time. Then is the profit budget. Profit budget is a budget which enables the ascertainment of profit, like sales budget, profit or loss budget. So we make a complete sales budget where we can show the contribution, where we can show the profit or loss budget. And the master budget, somebody asked. So master budget again is the complete budget. You must have done the cost sheet by now. So the complete budget is the master budget, from the sales till the profit. Master budget is broken into different formats. So somebody asked a master budget. So master budget is exactly, you can see the cost sheet, the projected cost sheet of the next year is a master budget. And master budget is broken down into various functional budgets. All right. So for example, we start with the direct cost, and under direct cost, we start with raw material. So then raw material budget will be a separate budget. Under raw material budget, we'll have two types of budget: raw material purchase budget, raw material consumption budget. Then we have a direct labor. So we have a labor budget. Then we have all the three overheads, administration and selling and distribution and manufacturing overheads, all these overheads budget. Then we have the sales budget. In sales budget, we show the volume, we show the sales per unit, how much sales is expected to happen during that given period of time. So master budget is a complete budget. And master budget is broken down into various functional budgets, what we call about. We'll be learning them in the due course of time in the following slides. So that is roughly called the master budget. Financial budget, a budget which facilitates in ascertaining the financial position of a concern, cash budget, capital expenditure budget, budgeted balance sheet. So we also make a budgeted balance sheet. So these are part of the financial budgets, which cater to the financial status or financial performance of the entire organization. So these are the four categories of budget, the domains of budget, under which there are different forms of budget we'll be learning. Budget manual. Now, again, this is very, very important. In simple terms, budget manual will tell you the SOPs. What are the procedures? How we make a budget? What are the rules, the regulations, the principles, the methods? How actually we make a budget? It is a manual. It's a guide. All right. It's a guide to the budget. How we are supposed to make the budget. So every information is there in the budget manual. Budget manual is a booklet specifying the objectives of an organization. So budget manual starts with what all the objectives of the organization are. Based on that only budgets are made. What is the demand of the organization? What are the policies, the vision of the organization? What the organization is all about in the long term. So based on that only budget is made. So that is again the first part of the budget. The objectives of the organization should be charted out first, and then its strategy. The budget is made to decide how much an organization would earn and spend, and in what manner. The organization costs its priorities too. So organization charts out what is important, what is not, how much cost it is planning to incur, how much investments it's going to make. On those bases, only budgets are made. So budget is a document which sets out the responsibilities of the persons engaged in the routine of and the forms and records required for budgetary control. So budget manual incorporates everything, what all documents are required, what is the format of the different budgets, everything will be there in the budget manual. What should be included in the raw material purchase budget, what should be included in the flexible budget, what should be the format of the master budget, what all information is to be required in every budget, what all information the management requires in a particular budget. So every format of the budget will be there in the budget manual. So it's a good guide to a person who is actually making the budget and who is a part of the the whole budgeting process. All right. So it's a very good guide, budget manual. So the person who is responsible to make the budget has to follow the budget manual very, very seriously and religiously. Effective budgeting planning relies on the provision of adequate information to the individuals involved in the planning process. So the individuals who are making the budget should have all the information. What should be the format? What should be all included inside the budget? What type of forecast to be made? How much, the budget period should we take? Should we take a long-term budget? Should we make a short-term budget? For how much period of time the budget should be made? So the whole information should be in the budget manual, and only then the proper budget, efficient budget can be made. So many of these information needs are contained in the budget manual. A budget manual is a collection of documents that contains key information for those involved in the planning process. So every information that a person requires to make the budget, the format, the period, the time, the information, quantity, quality, what all, units or hours or weight, whatever is required, whether it's a cost budget or an income budget, budget. Everything has to be there in the budget manual, which serves as a guide to the person who is making the budget. So contents of a budget manual. It's a statement. First of all, objectives of the organization should be there and how they can be achieved. Second, a statement about the functions and responsibilities of each executive, both preparation and execution. So one section of the people or the department will be making the budget, and the other section will be implementing the budget. So what all are their responsibilities while making the budget and their execution? So every person's responsibility will be charted out in the budget manual. Procedures to be followed for obtaining the necessary approval of budget. So this budget is made, who's going to approve, at what levels the budget has to be approved, who all are going to see the budget and vet the budget and approve the budget. So the whole procedure has to be charted out. The authority of granting approval, who is going to give approval for what type of budget, at which level a person is going to give approval. A form of organization chart to show who are responsible for the preparation of each functional budget. So the whole organization chart, there are different functional budgets. Who is responsible for cash budget? Who will be responsible for material purchase budget? Who will be responsible for production budget? Who will be responsible for sales budget? So every functional budget, the person responsible, everything has to be there in the budget manual. So it's a very, very good guide and a very important document on the basis of which the efficiency of a budget is basically based upon. All right. A timetable for the preparation of each budget, when production budget is going to be made, when cash budget is going to be made, at what point of time sales budget should be ready. So every timeline is mentioned in the budget manual. So the format, the timeline, the given period of time, see how important the budget manual is. The manner of scrutiny and the personnel to carry it out, who is going to prepare it, who is going to execute it. Reports, statements, forms, and other records to be maintained. So along with the budget, what all records and extras to be made, that again, everything is mentioned in the budget manual. The accounts classification to be employed. It is necessary that the framework within the cost, revenue, and the financial accounts are classified, must be identical both in the accounts and the budget department. So if we are making a separate factory overhead, selling and administration overhead. So if selling and distribution are together, or selling are separately and distribution are separately. So every head of the budget, every head of the format has to be explicitly defined in the budget manual. All right. The reporting of the remedial action. Who is going to report? Who is going to check the deviations? Who is responsible? Everything is started out. The manner in which the budgets after acceptance and issuance are to be revised or the matter amended. Even if the budgets are made, then we have to update the budget. So when and how the budgets will be updated, when and how it will be amended, when and how the approval has to be taken, and when and how the action, the upgraded budget or the updated budget will be exercised or implemented. Everything is mentioned in the budget manual. I hope you've understood. This is very important, the budget manual. All right. Let me see if there are any queries before I proceed further. Okay. So Sheil, why are we preparing budget? Okay, don't you basically plan before, let us say we have to going out for a vacation, don't we plan anything? Or let us say for the next year, don't we plan that, okay, this much saving we require, this much expenditure should be incurred on, investment, this much money will be investing next year, this much money will make expenditure, this much money will be saving, this much money, you will buy something which you like. Okay, so everything has to be charted out. We do it's all about the personal finance also. So we plan our own finances. So when we talk about the organization, a lot more of planning is required, don't you think? So that is why the budget is made. Suppose next year we have to produce 50,000 units, or we want to double the production. Don't you have to arrange the capital? Let us say you have to go for a foreign vacation next year. You want to go for a foreign vacation. Don't you have to plan the whole, from where the money is going to come? Well, you have to plan everything. And if you have to go for a foreign vacation, you plan everything, the whole itinerary of it you plan. Okay, then we'll be staying here. You book the hotel, you book the everything, you book the travel itinerary, you book. So when it comes to the organization, the planning gets manifold. So if we plan our personal things also, our personal finances also, our personal savings also, then when we talk about the organization, the planning gets manifold. So if we want crores of investment, we have to plan for it. We have to arrange resources for it. We have to arrange capital for it. We have to make a setup for the whole scenario for the next year. So budget is that part of planning. Budget is the planning part. And then according to the budget, we have a direction. Okay, this way we have to go. So budget gives you the direction for the next year. What exactly you have to go to do to the next year, budget gives you that direction. And then you follow the direction. Of course, the budget, what you plan and then what actually happens are totally different, right? So you plan your vacation and then we actually go to the vacation. Everything does not go as per plan, right? So that's the variation. That's the difference between budget and the actual scenario. That's the difference between the planning and when you actually act upon it. So budget is that important to an organization. So, but when planning is important at our level, you just imagine how much planning is required at an organizational level. All right. I hope I'm able to answer your query. All right. Okay. Understood. Let us now proceed. So I hope no query as such as of now. So different types of budgets. So there are different categories of budget, capacity wise, function wise, master budget, and period wise. All right. Capacity wise, fixed budget and flexible budget. Of course, we are going to learn all these kinds of budgets in the following sessions and the following slides. Fixed budget remains fixed. All right. It will not be changed as, according to the circumstances, according to the level of activities, it will remain as fixed. So fixed budget is more or less, required when there is a stable organization. There are no such marketing changes, no much output changes. So every year, more or less, the same quantity of output is produced. The same marketing policies are used. The same, product is not going to change over the next few years. So product is same. The technology is same. The marketing policies are same. The methods are same. The production output is more or less will be the same. So in that scenario, fixed budget can be helpful. So fixed budget is, if I'm making a budget for 10,000 units, everything will be as per the 10,000 units, and the actual scenario will always be 9,000 or 11,000 or 12,000. So when there is no more deviation generally, because budgets are made on the basis of past performance. So if there are past performance of the output or the sales or the methods, or the technology is also the same and expected to be same in the next few years, then fixed budget is comfortable to use. But when there are many changes which generally comes in the product, every year the product is changed, every year the technology changes, every year there's a lot of fluctuations in the output. So in 1 year the output is 5,000 units, in another year the output goes to 12,000 units. So if there are a lot of deviations in the production, then fixed budget is not successful. In that case, flexible budget is the option. All right. So flexible budget changes as per the capacity of the factory, as per the capacity of the organization. So fixed budget and flexible budget. Function budget. So functions budget, according to the functional, the budgets are made. So there are a lot of functional budgets. The sales budget. So sales budget is basically telling you the volume of sales, the units, the selling price, how much sales we are expected. Production budget, of course, production budget, how much output we are expecting next year or whatever is the time of the budget. Plant utilization budget, how much capacity of the plant we are expecting in the budget period. All right. Direct material usage budget. Usage means consumption. How much direct material consumption we are expecting. All right. Next year. Direct material purchase budget. So on the basis of production, on the basis of output, how much direct material purchase we have to do in the next year. On the basis of consumption, we have to plan how much direct material is expected to be purchased also. See, all types of planning we are doing. That's the budget. All right. Factory overhead budget. So these are the overheads budget. I hope you remember there are 3 overheads: production overheads, or manufacturing overheads we call, office and administration overheads, and selling and distribution overheads. And for that also we make the budget. So factory overhead budget, production cost budget, how much production cost is expected to be incurred, so that we can plan the resources accordingly. All right. So the cost of goods sold budget, selling and distribution cost budget, administration expenses budget, research and development cost budget, how much R&D is going to take and how much is the budget of the R&D department is going to be, incurred in the future period. Capital expenditure, how much capex we are planning to incur in the budgeted period. And of course, the cash budget, how much cash is expected to be arranged, how much cash we have to maintain, how much cash balance we have to maintain. So everything is basically planned in advance for the future period, for the future definite period. All right. Master budget, that I told you, master budget is a complete budget, and master budget is only broken down into various functional budgets. And then period wise, long-term budgets ranges from around 3 years to over 10-15 years. So long-term budgets has a long-term period for the budget. We plan for around 3 to 10 years. Short-term budget are basically till 2 years. So from 1 to 2 years is a short-term budget. 1 to 2 to 3 years maximum is a short-term budget. Current budget, we can make a budget for a month also, we can make a budget for years also, we can make budget weekly wise also. The current budgets as and when the need arises. So current budgets are made as per the requirement of the organization. All right. Let us say there is some event which is going to happen after 6 months. So then we make a budget for that particular after 6 months. So current budgets are as per the requirement. It could be monthly or weekly or a quarterly or an yearly budget. Short-term budget, 1 to 3 years. Long-term budget, 3 to over 10 years. So that is the long-term budget. So these are all the types of budgets we are going to learn in the budgetary control session. Okay, so we have one illustration for you. Just take a note of this illustration, please. Let me see if there are any queries. Budget at time for examination preparations. Yeah, actually, this is Manoj, very interesting. Basically, you have given. We budget the examination preparation. That means we plan. All right. Of course, it not involves any monetary thing, but yes, as per the time you plan, okay, this subject will take this and this subject will take. And when you actually study, do you actually study as per your plan? So there are a lot of deviations, right? So you update your plan, okay, now this much time has left. Now you update again your plan. So you again plan for the rest of the time, because planning and actual, they hardly match. All right. And if they matches, I mean, it's the person must be very efficient. All right. So that is how we go for it. If we require loan or we need to know business working capital changes, this budget helps business owner to know its business overview, taking decisions regarding production. Of course, it's all about planning. If we are planning the production, if we are planning the capital outlay, if we're planning the working capital, we need to plan the resources. We need to arrange the employment of capital. We need to channelize the resources. So that is again the budget which is going to help us to plan for the future. In every way, in the quantity, in the monetary terms, in the financial terms. If you want to take a loan, suppose we have to arrange the capital. So how we have to arrange the capital? If I have very less savings, we have to arrange a loan. So it will take time, so that I can arrange a loan in advance, so that there is no restriction when actually the time comes and for the action of the implementation of budget. So budget is a very, very fundamental guide for the organization to function. Which type of questions can be asked from this chapter? Janish, of course, you can be asked any type of questions, theoretical or practical, but yes, you will be asked to make the budget, all right, which we'll be doing now. So till now, I have explained you the concept of budget, budgetary control, and budgeting, and what all types of budget are, and what is the importance of budget manual, and how what should be the prerequisites, or what is the advantages of making a budget. Now we'll be understanding how we make a budget, all right? So every budget has a different format. Every budget is different. Every budget will give you a different information. Every budget together, like we cannot just use the production budget in isolation that, okay, we want just the production budget. Every organization has to make, if they are making the budgets, every type of budget is important. It's not that only we make a production budget and that's all. No, every organization, if they are making a budget, production budget is also required, cash budget is required, capex budget is required, raw material budget is required, sales budget is required. So it's not that you can cherry pick any budget which you want. No, every budget is important, because the whole lot of budgets, all the functional budgets together form a master budget. So whatever is crucial to the organization, you have to make that budget. And most of the budgets are made by every organization if they make the budgets. All right. So every budget together is implemented. It's not that only production budget is implemented. Production budget is going to tell you how much output is expected to be produced next year. So to produce that output, then raw material budget will be prepared that, okay, this much production has to happen. So this much raw material is required. So that is the consumption budget. And then if this much raw material is required and this much raw material is in stock, so how much to be purchased? So every budget is interrelated. It's not that only one budget we will be making and that is sufficient. Every budget is important. Every budget is interrelated. So and every budget has its own significance also. All right. So I think when we'll be doing the question, you'll understand it better. Just take a note of this question. A factory which expects to operate 7,000 hours, that is 70% level of activity, furnishes details of expenses as under variable, semi-variable, fixed expenses. What are semi-variable expenses? Anybody? Now you have, mostly you have covered all the units in the cost and management accounting. So now you should know all the terms and the meaning. So what do you mean by semi-variable expenses? Because semi-variable expenses are important if, they are used in marginal costing also. They are used in many other units also. And it's important for budget also. All right. So what are semi-variable expenses? Anybody who can give me this answer? So the semi-variable expenses go up by 10% between 85% and 95% and by 20% above 95% activity. Prepare a flexible budget. So basically, we have to make a flexible budget here. So you have to make a flexible budget for 80, 90 and 100% activities. All right. So anybody who can, okay. Partly fixed and partly what? Fixed up to some stage and after that changes with production, okay? Up to certain limit is fixed and further is partly fixed and partly variable, yes. So semi-variable are partly fixed and partly variable. I can take this answer. So whenever there are semi-variable, we have to split between fixed and variable expenses, all right? So factory which expects to operate 7,000 hours, so you can make a statement of the budget. See, 70% is given to us. And then you have to make for 80, 90 and 100%. 80%, 90% and 100%. First of all, you have to make for 70% as it is given. So first should be the hours. All right. So if 7,000 hours are at 70% level of activity, 7,000 hours are at 70%. So 7,000 hours are 70%. How many hours? First, you have to take the budgeted hours, all right? So the budgeted hours are 7,000 hours for 70%. Can you find out the budgeted hours for 80%, 90%, and 100%? You have to make a flexible budget. See, what is called the flexible budget? Flexible budget will change as per the capacity of the organization. So if the capacity is 70%, this is the budgeted hours. If the capacity is 80%, it is expected to be 80%, the budget is going to change for 80%. So 80%, 90%, and 100%. See, flexible budget will give you flexibility at different level of activity, at different level of production. So if the production capacity is 70% or 80% or 90% or 100%, flexible budget will give you the budget, will give you the estimate for every level of activity. That is the importance and significance of flexible budget. This is very, very suitable for such organizations where the technology changes very rapidly, the product changes, the quality of product changes, the formation of product changes, the techniques of production changes. So in this type of organization, flexible budget is very useful, because flexible budget, you can adapt as per the level of activity and as per the level of changes. All right. If there is increase in the material cost or labor cost or the wages cost or whatever, there's an expected to increase or decrease. Flexible budget takes care of all the changes which might happen in future at different level of activities. So that is the significance of all right. So yes. 7,000, 8,000 budgeted hours for 80%, 9,000 budgeted hours for 90%, and 10,000 budgeted hours for 100%. So this way you have to, first of all, you have to calculate the budgeted hours. All right. So 7,000 hours at 70%. So we have calculated the budgeted hours at different levels of activity. Then variable expenses are there. Semi-variable expenses are there. And fixed expenses are there. All right. Only the three categories of expenses are here. So in this question, you don't have to split between semi-variable, the fixed and variable. This is a different type of question. So let us first see the variable expenses. I'm just posting for the 70%. Information for 70% is given. On the basis of this information, we have to find out the information for 80, 90, and 100%. Now, what are variable expenses? What are the properties of a variable expense? What are the properties of a variable cost? Can anybody tell me? What are variable expenses? What are fixed expenses? What is the property of a variable expense? How the variable expenses are denoted? Anybody can give me this answer? What is the main property of a variable expense and what is the main property of a fixed expense? I'm just waiting for the answer. This is very important. This is important for the cost accounting as a whole. This is very important. With the main property of a various expense, the main characteristic of a variable expense. Changes with production. Okay. Any other thing? Any other property of a variable cost? Of course, variable cost changes with production and fixed cost does not change with production. Any other property of a variable cost or a difference between variable and fixed? It changes with production. That is okay. That is a main property. There's a main characteristic, but there's one more characteristic of a variable cost or a variable expense that is going to help you a lot. All right. The second, which are depending upon the variable times, variable changes to production, fixed cost changes with per unit. All right. Now let us just, what I'm trying to explain is, see, variable cost is generally denoted in per unit. That you need to understand. All right. And fixed cost is generally denoted in total. So variable cost changes. Variable cost changes means numerator divided by denominator. The numerator also changes, so the denominator also changes. Numerator and denominator. Numerator and denominator means the variable cost divided by units. So variable cost also changes and units also changes. So what is the effect of it? Per unit remains constant. All right. So when the numerator and the denominator changes in equal proportion, the per unit remains constant. But in fixed cost, what happens? Fixed cost divided by units. In fixed cost remains constant, but the unit changes. So that means the per unit fixed cost also changes. Clear? That is the difference. Variable cost, the variable cost also changes and the units also changes. Units of production also changes in equal proportion. So the variable cost per unit is constant. But fixed cost per unit changes. Why? Because the numerator does not change. Fixed cost remains constant and the units keep on changing. So the per unit fixed cost per unit always changes. Clear? So this you should understand, and variable cost is generally denoted in per unit. Clear? It is generally denoted in per unit because it is applied to the units produced. So variable cost per unit remains constant because the numerator and denominator both changes in equal proportion. That you need to understand and remember. Clear? Coming to the question. So variable expenses 1260. Semi-variable 1200, it's given for 70%, and fixed expenses are 1800. So fixed expenses 1800, fixed expenses will continue to remain 1800, because these are fixed expenses. Sorry. All right. So this will be 1800. All right. Now coming to variable and semi-variable. Let us first do the variable. 1260 variable cost. Whenever you calculate variable cost, remember you should calculate per unit. Variable cost per unit. I'm repeating. Whenever you calculate variable cost or whenever you have to apply variable cost, it should always be calculated per unit. So you calculate per unit of variable cost and then apply it to wherever you want to. All right. So variable cost is 1260 divided by, so cost divided by units. Clear? So variable cost per unit is equal to variable cost divided by total units. All right. So variable cost is 1260 divided by, it's 60 divided by 7,000 units. Please calculate variable cost per unit. It is 0.18, 0.18. Variable cost per unit is 0.18. Now you calculate the cost for the 8,000 hours, 9,000 and 10,000. Okay, these are the budgeted hours. So here in spite of units, there are hours. All right. So it could be units or it could be hours. So 0.18 per hour. All right. So can you calculate the variable cost? Let me see if there are any queries. Yes, very good. Clear? So 0.18 is variable cost per hour. I'm repeating. Whenever you have the information for variable cost, convert the variable cost into per unit or per hour, whatever as per the question is, the information is given. So 0.18 per hour is the variable cost. Now you just apply 0.18, 8,000 into 0.18, 9,000 into 0.18, 10,000 into 0.18. You will get the variable cost for all the three. Quickly calculate 1440 for 8,000 hours for the 80%. For 90%, it will be 1620. And for 10,000, it would be 1,800. All right. So the variable cost, first step, calculate the per unit variable cost or the per hour, whatever the information, and then multiply it with whatever the level of activity is given in the question. It has to be converted into per unit. All right. So per unit, variable cost per unit will always be constant. It will be 0.18 only for every level of activity for this question. So it always remain constant. All right. I hope you have understood this. Anybody who has not understood, please let me know. Semi-variable. Now, normally we split the semi-variable into fixed and variable, but in this question, there is no need to split between fixed and variable. They are saying semi-variable expenses go up by 10% between 85% and 95% activity. Clear? So between 85 and 95, that means till 80%, semi-variable is not going to change. Semi-variable will remain the same for 80% because it's going to change between 85 and 95. So till 80, semi-variable expense is not going to change. I hope you have understood this. So it will go up only beyond 85. Clear? So till 80, semi-variable will remain the same. Yes, 90% now semi-variable will change and it will go up by 10%. So 1200 plus 10%, it will be 1320. Beyond 85 till 95, it will be 1320. All right, because semi-variable has a portion of fixed also. So till certain level of activity, it's going to be fixed. All right. Above 95%, it will increase by 20%. Above 95%. Above 95, that means for 100%, it will be above 20. It will be increased by 20%. So 1200 plus 20%, 1440. 1440 will be for 100%. I'm repeating. 70% was given 1200. Till 80%, it will always be, it will also be 1200 because semi-variable expenses will increase after 85%. So for 90%, we have increased by 10% and beyond 95%, we have increased by 20%. So this also this will be the total cost we have with us, 70%, 80%, 90% and 100%. So this is the flexible budget we have made for every level of activities. For 70% we have a total cost, for 80% we'll have a total cost, for 90% we'll have a total cost, for 100%. So whatever is the level of activity, flexible budget gives us the estimate that what cost should be. I'm repeating. Flexible budget gives you an estimate. It's an estimate. It's a forecast that at this percent level of activity, this should be the cost. All right. Can you give me the total cost at 80%? Anybody? Can anybody give me the total cost at 80%, 80, 90, 100, whatever you have calculated, or even for 70%? So which expects to operate at 70% level of activity. Can you give me the cost? Any one of you? Anybody has calculated the total cost? Or let me see. I've got the solution also. I hope yes. Okay. So this is the solution we have. So 7,000, 8,000, 9,000, 10,000. Just have a look of the solution. 70% at the total expenses are this. 80% the expenses are this, 90% is this, and 100% is this. So flexible budget gives us the cost at different level of activities. So if I am operating at 90% capacity, the cost should be, the cost should be 4740. So if the cost is, let us say 4,900, the actual cost is 4,900, that means there is a deviation. All right. So it is the budget gives us what the cost should be. If you are operating at 80, 90 or whatever is the 100%, then the actual cost has to happen. Then we will compare that what the cost should be and what is the actual cost. All right. So you can see the conclusion also. We notice that recovery rate is 0.61 per hour. So we have calculated the recovery rate. Recovery rate means total cost divided by total hours. So how this has come? 4260 divided by 7,000 hours. All right. So 0.61 per hour is going to come. How 0.55 has come? 4440 cost divided by hours. How 53 has come? 4740 divided by 9,000. How 0.5 has come? 5040 divided by 10,000. All right. So budgeted or recovery rate per hour is cost divided by hours. All right. So this is the recovery rate per hour. You must have done overheads also. So we calculate the recovery head per hour. So like this. So this the cost should be. All right. So if in a particular month the factory works for 8,000 hours, it will be incorrect to estimate the allowance is 4880. The correct allowance will be, so if the factory works for 8,000 hours in any particular month, the cost should be 4440. If the actual expenses are 4,500, the company has not saved any money, but has overspent by 60. Same, I've also given you another example. If the cost at 90% should be 4,740 and the actual cost comes to 4,900, that means the organization has overspent. So 4,900 is the actual cost minus the budgeted cost should be this. So whatever is this, it should be minus. That means the company has overspent it. All right. This is the way why we make the budget and why and how we make the analysis and how we create the differences between the budget and the actual. So all these are planned cost. And then we'll compare these planned cost with the actual cost that is going to happen. I hope the concept of budget is clear to all of you. Yes. Most of you have calculated the correct answers. Yes, all right. So I think the concept is clear and this particular example and question is clear to you. Shall we move on? Are there any queries for this particular question or shall we move on? All right. Let's move on to okay, there's another illustration. Just take a note of this illustration. A department of company X attains sale of, so it is given in terms of sale of 6 lakh at 80%. So 6 lakh rupees sale is at 80% of its normal capacity and its expenses are given below. So the expenses are administration cost, selling cost. See, so under administration cost, there are fixed cost also, there are variable cost also. Any percentage of sales will be taken as variable. And anything which is given as fixed amount is be treated as fixed. So there are selling cost also, salaries. So all the selling costs are variable. Clear? They are as a percentage of sales. So they are variable. Anything which is given as a fixed amount, absolute amount is considered as fixed. Clear? So this way you have to understand the question also. Any other costs are mentioned? All right. So distribution costs are also given. So you have to make a flexible administration, selling and distribution cost budget. See, the whole functional budget is broken down into different functional budgets. Clear? So this is that when you make a cost sheet, you have the factory overheads, administration overheads, selling and distribution overheads. We make separate budget for these costs also. So operating at 90%, 100% and 110%. All right. So we have to make a column for 90%, then 100% and then 110%. Here. So the capacity should be at the top. The first thing in the format, in the statement which you make should be the capacity. Clear? So let us go back to the first part of the question. So 80% capacity, you can write it over here also. 80%, 90%, 100% and 110%. So 80 is given to you. Clear? On the basis of this, we will find out 90, 100 and 110. So first of all, you can write down the administration. All right. For 80% I'm telling you, and then you can proceed. So everybody makes a statement. 80% semi-variable expenses, why not change? 80% semi-variable, why not change? Because they must be the fixed portion of the semi-variable. Something which is not changing. Any proportion in the semi-variable which is not changing must be due to the fixed factor, because semi-variable is made up of fixed and variable both. So the variable portion is changing. The fixed will not change. So 80% must be the fixed proportion. All right. So Ved Prakash, I hope you have understood now. Yes, increase, then expenses also will increase. So fixed expenses don't change with the level of activity. Fixed cost does not change with every level of activity, especially every 10 or 20% level of activity. So something which is not changing must be the fixed proportion. All right. This is a prior step of standard costing. Yes, it's a prior step of C. But when the budget is going to happen? Budget happens after forecast and before standard costing, right? So budgets are a guide to standard costing also. But forecasting happens before budget. So I go to a market survey. Who has asked this question? Dianesh. I go to a market survey. I go for a market survey that how much sales should we project for the future. That is a part of forecasting. So a forecasting team will go to the market. They will explore the market. They will understand the customer taste and preferences. And they find out that, okay, next year, probability our sales are going to increase. So they give information to the budget department, then budget is made on the basis of forecast. All right. And then on the basis of budget, standards are made. So standards and standards are made as per the actual production and the output. Budgets are a total estimate which are based on the forecast. So forecasting happens, then budgeting happens, and then standard costing. So I hope you understand the sequence of it. All right. Now let us move back to the question. All right. So administration costs, first of all, office salaries are fixed. Office salaries are fixed 90,000. So for 90%, it will be 90,000. For 100%, it will also be 90,000. For 110 also, it will be 90,000. See, students, what happens is, generally, when we go beyond 100, the fixed cost also changes. All right. Why? Let us say I have a factory area where I am operating at 100% of the capacity. So in that factory, so if I just give you this example, let me just explain you what I'm trying to want to explain. So this is a factory area, all right? The maximum production in this factory can happen, let us say 10,000 units, all right? So if I'm operating at full 10,000, I am operating 10,000 units only. The current production is also 10,000. So the maximum production that this factory can produce is 10,000 units, and I am actually producing 10,000 units. So I am using the maximum capacity of the factory. Now, if I go beyond plus 10%, that means I'm producing 11,000. So for that excess 1,000, I have to expand the factory area, and this will call for additional fixed cost. All right. So generally, when you go beyond your maximum capacity, fixed cost also changes. Till this proportion, fixed cost remains same, because let us say the rent of the factory is 1 lakh. So till 10,000, because 10,000 units can be produced in this factory area. So till 10,000 units, the rent will be 1 lakh. Whether I'm producing 1,000 or 10,000, or I'm not producing anything, still I have to pay the rent. That is the property of a fixed cost. Fixed cost does not change with the level of production or with the level of output. So till maximum production capacity, the fixed cost, the rent, let us say this is the fixed rent of this factory, we have to pay. But if I am increasing the capacity of the factory beyond maximum, beyond 100%, let us say plus 10%. So for additional 1,000 units, I have to expand the factory area, and let us say I have to pay extra 20,000 rent. So additional fixed cost will be 20,000. So generally, when we exceed the maximum production capacity, which is 100%, generally fixed cost arises. Fixed cost also changes. Clear? But in this question, it does not seem to change. If you can see, till 110% capacity, there is no additional fixed cost they have mentioned. So we will be assuming that at 110% also, the fixed cost does not change. I hope you got the concept which I'm trying to make you understand. All right. So till 110 also a fixed cost will remain same in this question. But generally there's additional fixed cost which is incurred when we go beyond 100% capacity, because we have to expand the factory setup or the production setup, right? Now, general expense is 2% of sales. So first of all, you have to find out the sales. The first step, the sales. At 80% capacity, the sales are, just find out. I'm just erasing it off. Okay. So 80% the sales are 6 lakh. Can you find out the sales at 90%? The sales at 6 lakh, 80% is 6 lakh. Can you find the sales at 90%, 100%? Okay. Yes, first we have to take sales. So give me the sales for 90%, 100%, and 110%. Anybody else calculated, or should I calculate? All right, 80% the sales are 6 lakh. So how you will calculate for 90%? If 6 lakh is for 80%, you have to calculate for 90%. So for which you have to calculate, it will come in numerator. And what is that you are taking as 6 lakh as the base, it will be 80. Clear? So 6 lakh is for 80. We have to calculate for 90. So 90 will be numerator and 80. The base which you are taking is for 80%. So 6 lakh into 90 divided by 80. It will be 6,75,000. Yeah. 6,75,000. So this is the way I hope most of you will calculate, but those who don't know, I'm just explaining for them. For 100%, how you calculate? So if 6 lakh is for 80%, how much it will be for 100? So it should always align because 80% 6 lakh. So whatever for which you have to calculate will be coming in the numerator. So 6 lakh into 100 divided by 80. It will be 7,50,000. So this way you have to calculate. Now try for 110. So this will be 110 for 110. So 6 lakh into 110 divided by 80. How much you are getting? 8,25,000. 8,25,000. Clear? So anybody who has still not understood how we have calculated, please ask me again. Okay. So we have got the sales now. Now the administration expenses are going to be same. They are fixed. General expenses are 2% of sales. We know the sales. Can you calculate general expenses? 2% of sales. So 2% of 6 lakh, 2% of 6,75,000, 2% of 7,50,000, 2% of 8,25,000. Quickly calculate general expenses, all of you. Please calculate general expenses. Anybody has any problem how we have calculated the sales? Please ask me if you have any problem. All right. So if you have managed to calculate, then let us start the costing. So administration, the office salaries are fixed. 90,000, that means it's a fixed cost. Anything which is variable will be as a percentage of sales in this question. As you can find out, variable cost always changes with the output or the sales or the units or the hours, whatever information is given in the question. And this information is going to change as per sales. And something which is not going to change as per sales, it means it's fixed cost. So office salaries are fixed, depreciation is fixed, rates and taxes are also fixed. So and under administration, salaries are fixed. General expenses, 2% of sales, 6 lakh into 2%. Come on. 6 lakh into 2%. Please give me the figures. All right. So 12,000, of course, it's 2% of 6 lakh. It has to be 12,000. Then 13,500 is a percentage of sales, as you can find out. Then for 100%, it has to be 15,000, and for that it has to be 16,500. General expenses as a percentage of sales. Depreciation is fixed. 7,500, 7,500, 7,500, and even for 110%, it's 7,500 since no information is given. Rates and taxes are fixed. 8,750, 8,750. 8,750 and 8,750, it's fixed. So whatever are fixed will be fixed for every level of activity. Clear? So these are the administration cost, selling cost, everything is variable. 8% of sales. You know the sales of at all the 4 levels. 6 lakh, 6,75,000, 7,50,000 and 8,25,000. You know the sales at all the 4 levels and calculate the percent. So 8% of sales, 2% of sales, 1% of sales, and again 1% of sales. So I hope you will be able to calculate this. Selling cost. Just calculate the percentage of sales. And then you have the distribution cost also. Distribution cost, wages are fixed. The distribution cost, wages are fixed. So it will be 15,000, 15,000, 15,000 and 15,000. Wages are fixed. And this is variable. Rent and other expenses are variable. So see, we have made a flexible budget. In flexible budget, we make for different levels of activity. So in flexible budget, you will be asked to make a flexible budget at, let us say, 80%, 90% or 100%, or at different sales levels, or at different hours levels, or at different output levels. So flexible budget generally made for 2-3 levels of activity together in one budget. That is flexible flexible budget. If it is a fixed budget, what it will be? So suppose if we are talking about fixed budget will only for 80%. That's it. You expect a level of 90% or 100%, whatever. Fixed budget is not going to change. So if we talk about fixed budget, it will remain at 80% fixed, no matter how much level of activity you are expecting. Fixed budget remains fixed at a certain level of activity. That's all. No other level of activity will be made under fixed budget. But under flexible budget, we make a budget at different levels of activity. All right. So that if we expect to be at 100%, we have the ready-made cost, the budget at 100%. If we expect, let us say after 6 months, we see that, okay, we can even, expand to 110%. We've already made the flexible budget at 110% also. So we have a ready, the cost which should be there at 110%. So that is the significance of a flexible budget. It makes us to make the budget at different levels of capacity in advance only. So we make the budget for different levels of activity much in advance, so that if any level of activity we expect to reach, we have the cost with us, the budgeted cost with us. But fixed cost, irrespective of any estimate, we will be fixed at 80%, whatever level of activity we are expecting. So that is the difference between fixed and flexible budget. So I hope you've understood the concept, the fundamental behind it. All right. Now, can I have the, I think we should have the, okay, we have the solution also here. So see, we have already done this. So 80%, 90%, 100%, and 110%. This is the sales we have calculated. So you can check your answers, students. Okay, good that you have taken, Sunil, good, you calculated the cost also. So see, administration cost, salaries were fixed, clear? And general expenses were as a percentage of sales. So sales is given, just 2% of sales will be general expenses. Okay, students, now am I audible? Can you hear me now? We were at this solution. Are you able to understand? Any doubts you can ask? Am I audible, students? Just confirm, any one of you. Students, am I audible? Anyone can check and confirm. Shall we proceed with the next question? Okay. All right. Thank you for confirming, Sunil. So let us proceed. I think this solution is clear to you, all of you, and no doubts on this question so far. So let us move to the next. Okay, so we have another illustration. All right, just take a note of this illustration, all of you. Action plan manufacturers. Let us try to understand what it expects us to calculate. Action plan manufacturers normally produce 8,000 units of their product in a month in their machine shop. All right. So they normally produce 8,000 in a month. So it's a monthly production for the month of January. So for the month of January, they had planned for a production of 10,000 units. So normally, which is already happening, the current production normal is 8,000. They planned for January 10,000. Owing to a sudden cancellation of a contract in the middle of January, they could only produce 6,000. So 6,000 is the actual production they could make. Clear? So 8,000 was normal. The planned was 10,000. So they must have made a budget for 10,000. All right. See how we have to relate. 8,000 what we normally were producing, and 10,000 they must have made the budget for 10,000 because they planned that now it can be increased to 10,000. But the actual, due to some problem in the cancellation, they actually produced 6,000 units only in January. Yeah, so you have 3 units. So we have to make a statement for 3 units. That is very clear from this question. See, when you do the questions, you will actually come to know what all is expected from you to calculate. So we have to calculate what is, see, I have not just read the question, but from the first paragraph, it's very clear. You must have to make a statement for 8,000, 10,000, and then 6,000, right? Okay. Indirect manufacturing costs are carefully planned and monitored in the machine shop, and foreman of the shop is paid at the 10% of the savings as bonus when in any month the indirect manufacturing cost is less than the budgeted. So if the actual cost is less than the budget, the foreman of the shop will get a bonus of 10% of the savings. So what all is the saving? That means actual cost must be less than the budgeted cost. So whatever is the difference, 10% of that savings, the foreman of the shop will be given as a bonus. The foreman has put in a claim that he should be paid a bonus of 88.50 for the month of January. The works manager wonders how anyone can claim a bonus when the company has lost a sizable contract. So the manager says that we've already lost the contract. All right. So how can he claim the bonus? So they are given the figures now. All right. So this is the question. Expenses for a normal month. So normal month is 8,000. All right. Normal were 8,000. Planned for January was 10,000 units. And the actual cost must have happened for 6,000 units. No, actual cost is, yes, actual cost happened for 6,000 units. This is the actual cost. All right. So we have salary of foreman, indirect labor, indirect material, repairs and maintenance, power, tools, consume rates and taxes, depreciation and insurance. Do you agree with works manager? So works manager is asking you to compute whether we should give bonus to the foreman or not. Is the foreman entitled to the bonus for the performance in January? Substituent should answer with facts and figures. So you have to make basically a data for a chart for normal month, planned month, and then so expenses for normal and planned are given to you, and the actual cost for 6,000 is given. Clear? So what you're supposed to do? See, you have to make a planned for 6,000. planned for 6,000 units. You got it? This is the cost for 8,000. This was the budget for 10,000. But we don't have a budget for 6,000. Clear? Because actual cost for 6,000 is given. We should have the budget for 6,000. Then only we'll be comparing. We can't compare 6,000 with 10,000. We have to compare 6,000 with 6,000 only. So we have the statistics for actual data on under 6,000. Now we have to prepare the planned statistics for 6,000. That means the budget for 6,000. This is actually we have to prepare. So we have to prepare the budget for 6,000 units. Actual 6,000 we already have, so that we can take the difference, that what the cost exceeded and what the cost actually was less than the budgeted. Clear? And how we are going to make the budget for 6,000 on the basis of 8,000 and 10,000 budget that has been given to us. Clear? So this is how the way we have to do. Now, before we start, we should know how many are fixed and how many are variable or semi-variable, right? So if I can see salary of foreman appears to be fixed, so it has to be fixed for 6,000 also. Clear? I hope you got the structure of the question. Students, half of the battle is won if you actually understand what is expected out of you. Clear? You have to calculate the difference between the actual cost under 6,000 units and the budgeted under 6,000 units, because we made the budget for 10,000 units. But due to some exigency, the units produced were 6,000. So actual cost is given for 6,000. We will make a budget for 6,000 and then we will be comparing. So these two parts we have to compare. So budget will be making on the basis of, so these two information are given so that we can make a budget for 6,000 also. Clear? So salary is very clear. It's a fixed cost. Let us say any other fixed. Yes. Insurance is also fixed. So insurance is also fixed. You can place the fixed cost first. First, you just write all the left portion, the particulars, all the costs. You can just place it on the left side. Depreciation is also fixed, so it will be fixed for 6,000 also. Rates and taxes are also fixed, so it will be fixed for 6,000 also. Rest of these are either now this part. Now these are indirect labor, indirect material, repair and maintenance, power and tool consumed. Out of these, some are variable and some are semi-variable. Now, this is the main exercise which you have to do. You have to find out. See, fixed is quite clear. So, fixed, so we have written it first. Now, what are variable? How you have to find? How you can find what are variable? You have to calculate per unit variable cost. If the expense is variable, per unit variable cost will come constant. I'm repeating. To find out, to identify that this particular cost or expense is variable, you must calculate the per unit cost of it. If that per unit cost at every level is fixed, that means it's a variable cost. So per unit variable cost must be constant if it has to be a variable cost. If per unit is not same for every level of activity, that means it must have a fixed proportion to it also. So let us start with indirect labor. 720 for 8,000 and 900 for 10,000. Calculate the variable cost per unit for 8,000. So 720 cost divided by units. Cost divided by units. So 720 divided by 8,000. It's 0.09. 0.09 per unit of indirect labor. Now for this, multiply it by 10,000 into 10,000. It's coming 900. 0.09 into 1,000. Into 8,000 is 800, into 10,000 is 900. That means indirect labor is variable because 0.09 is actually coming as a variable cost. Now apply it for 6,000 also. 0.09 into 6,000. You will get the indirect labor for 6,000 units. So 0.09 into 6,000, it has to come for 540. This is the way you have to do. All right. So if something is variable, variable cost per unit will remain the same for every level of activity. So for 8,000, for 10,000, for 6,000, it will be 0.09. So 0.09 into 8,000, 720, 0.09 into 10,000, 900, 0.09 into 6,000, 540. I hope you have understood. Repair and maintenance power 2 is semi-variable. Let us see. Let us try to find out. Indirect material. Now go to indirect material. I'm just try to find out indirect material is variable or fixed. How we have to find out? Indirect material 800. 800 divided by 8,000. So 800 divided by 8,000, 0.1. 0.1 into 10,000. It's 1,000. So it is also variable because it's coming as 0.1 per unit. 0.1 per unit, and 0.1 per unit, if you multiply by 10,000 also, it's coming 1,000. Now multiply it by 6,000. It will be 600. So indirect material is also variable. Indirect material is also variable. If variable cost per unit is same and constant for every level of activity, it is a variable cost. Per unit should be same. Amount will be different. Clear? Any student has any problem, not able to understand how we are calculating, please ask me. But this is very, very important. Now coming to repair and maintenance. I'm just erasing it off so that it is clear to you all. All right. Okay, repair and maintenance 600. 600 divided by 8,000. Let us see if it's variable or not. 600 divided by 8,000. 600 is this and 8,000 are units. So cost divided by units is coming 0.075. 0.075. Now let us multiply it by 10,000 into 10,000. 750, but it's coming 875. That means it's not variable. It has to be semi-variable expense. Repairs and maintenance is a semi-variable expense. Is a semi-variable expense because variable cost per unit, if we multiply it by 10,000, it's coming to 650 and it should come to 750. That means it is not a totally variable cost. It is a semi-variable cost. Now, how to split a semi-variable and a variable? Now, just try to understand how we do it. Okay. Repair and maintenance semi-variable. Yeah. Power also just find out. Or let us see first the repair and maintenance. How we split the semi-variable into variable. So 600, difference between the cost at two level of activity. The repair and maintenance at 8,000 is 600. At 10,000 is 650. The difference between the two is 50. The difference between both the costs are 50. Divided by difference between the units. 8,000 and 10,000. So difference between the cost at two level of activity and difference between the units at two level of activity. So 50 is the cost difference and unit difference is 2,000. 8,000 minus 10,000, 2,000. Calculate the cost per unit. 50 divided by 2,000. 0.025. Now, this is the variable cost per unit you have found out. Variable cost per unit you have found out. It's 0.025. Clear? I hope I'm making you able to understand. Okay, so 0.025 is basically the variable cost. So how you have to split? So 0.025 into 8,000. Do it into 8,000. 200 should be the variable. The total cost is 600. After 600, 200 is variable cost and 400 must be the fixed cost. 400 must be the fixed cost for repair and maintenance. Let's do a similar exercise for 650. So 0.025 into 10,000. 0.025 into 10,000. 250. So split. Variable cost is 250. How? 0.025 into 10,000 is 250. Fixed cost will remain the same. Fixed cost will remain the same, and see the cost is coming to be 650. So repair and maintenance is a semi-variable cost, first point. Second point, you have to split the semi-variable into fixed and variable. You have to find out the variable cost, and the balance will be fixed cost. I'm repeating. You have to find out the variable cost, and then the balance amount will be fixed cost. How to find out the variable proportion, difference between both the cost and the difference between both the units. So 50 divided by 2000, 0.025 is variable cost per unit. Clear? So per unit variable cost we have found out, multiplied with by respective units, you will get the variable cost. So 0.025 into 8,000, if we split, variable cost comes to 200, fixed cost has to be 400. 0.025 into 10,000, variable cost comes to 250. The balance fixed cost will remain the same. It's 400. So the cost is 650. Calculate in the similar way for 6,000 units. Now you know the variable proportion of it. Fixed cost is 400. Fixed cost is going to remain same for 6,000 also. Calculate repair and maintenance cost for 6,000 units on the same way. 0.025 is the variable cost per unit and 400 is the fixed element in it. So please calculate and tell me how much will be the cost for 6,000. I'm just erasing it off so that you know. Okay, so for 6,000, if we have to calculate how much we have to, 0.025 into 6,000 will be the variable cost, and 400 is actually the fixed cost. 400 is the fixed cost. So 6,000 into 0.025, it's 150. That means the total repair and maintenance has to be 550. Any doubts, students? Yes, it is 550 for 6,000 units. How we did it? We have calculated the variable cost per unit as per the split method. Difference in cost divided by difference in units. The variable cost per unit is 0.025. Out of 600, how much will be the variable? 0.025 into number of units, and fixed cost will come out. So fixed cost is 400. It is coming. And variable cost multiplied by the number of units. Variable cost is 150. Fixed cost will remain 400 for every level of activity. 550 is the cost for 6,000 units repair and maintenance. Repeat the same exercise for power also. Power also will be semi-variable. How? Let us just find out. I'm just erasing the extra thing so that now I hope you have understood. Okay, so let's understand for power also how we do it. 550 is for repair and maintenance. Power, if you see 800. So 800 divided by 8,000. It has to be 10. So if I multiply 10 per unit with 10,000, it should be different, right? So 800 divided by 8,000 is 0.10. And 0.10, if we multiply by 10,000, it should be 1,000, but it is 875. That means power also is a semi-variable expense. Semi-variable. So if it's a semi-variable, you have to split. Now, how you will be doing it? Difference between both the costs, 75, and difference between the units, 2,000. You will be calculating variable cost per unit. How much is variable cost per unit? 75 divided by 2,000, it's 0.0375. 0.0375 is the variable proportion in the semi-variable cost. So 0.0375, now 0.0375 into 8,000 will give you the variable proportion. It's 300. So 800 variable cost is 300. Out of 800, if 300 is variable cost, 500 has to be fixed cost. Similarly, here also, now we know the variable cost, which is 0.0375 into 10,000. So 0.0375 into 10,000, it comes to 375. Out of 875, 375 is variable. 500 has to be fixed. See, fixed will remain fixed for every level of activity. So variable is 0.0375 per unit. That's what I was telling you. Variable cost per unit remains constant. Clear? Now apply it for 6,000 also. 0.0375 into 6,000 units. And fixed cost is 500. So 0.0375 into 6,000, it comes out to 225. So the total is 725 for 6,000 units. The total is 725 for 6,000 units. Students, any doubt here? Yes, 725 for 6,000 units. Out, because variable cost per unit we calculate as per the split method. Difference in cost divided by difference in units, and the balance will be the fixed cost. So we calculate, we split the variable cost, and the balance automatically fixed cost comes. We don't split the fixed cost. We calculate the variable proportion in it. So we separate the variable proportion and the balance comes the fixed cost, right? So this is how we split the semi-variable into fixed and variable. Students, I hope you all have understood this. This is very, very important part of budgeting also. The split between semi-variable into fixed and variable, all right? So now, tools consumed, I think should be variable. Tools consumed, just check whether they are variable or fixed. So tools consumed 320 divided by 8,000, 0.04 per unit. Just see if this variable or it's semi-variable. 0.04 into 8,000 is 320. 0.04 into 10,000 is 400. So if it is, tools consumed are variable only. Clear? So 0.04 into 6,000, it's still variable. 0.04 into 6,000. Tools consumed are totally variable. So per unit you calculate and multiply it by the 6,000 units. So this comes to be the variable proportion. I hope you have understood. So we have all the cost. The salary is fixed. Indirect labor, indirect material are variable. So just calculate per unit and then multiply it by 6,000. Repairs and maintenance power are semi-variable. We have split between fixed and variable. Tools consumed are variable. We have just calculated per unit and multiplied by the 6,000 units. Rates, depreciation, insurance are fixed. Yeah. So I hope you have understood, students. Yes, let me now show. I hope, yes, there is a solution to it as well. So you can see here. Nature of cost, salary fixed, variable, two are semi-variable, rest are fixed and variable. So actual expenses in normal were for 8,000, planned were for 10,000, expenses as per flexible budget, this is for 6,000. So we have calculated for this. Actual were already given. So we have just calculated the difference. Clear? So this was the supposed to be the budget for 6,000 and this is the actual for 6,000 and we will actually take the difference between the two. So nil, 60, 150. So this is the extra cost. This should be the budget. This should be the budget. This is the actual. Difference between actual, of course, actual is greater than the budget. So the deviation is 285. So 285 rupees we overspent. 285 rupees we overspent than the budget. The budget told us that it should be 4705, but the actual cost came out to be 4990. So the actual is greater than the budget. The responsibility has to be fixed that at which level the cost deviated more. All right. So this is how the budget helps us to check the deviations and check the overspending also, so that we can control the cost. All right. Through comparison between actual and the budget. So students, I hope you have understood this. You can take a note of the solution. So we have taken the base as 8,000 and 10,000. Two base are given to us so that it's because two are required to split between fixed and variable. So 2 units or 2 levels or 2 hours, whatever, two levels of activity are required if we have to split between fixed and variable. So that means the difference between is 50 and the difference is 75. We just divide by the difference of number of units also. So this is going to give us variable cost per unit here, and the balance is the fixed cost. So I hope you have understood. Any doubt in this question you can ask quickly before we proceed. Shall we proceed, students? Any doubt in this question? Anything? So the main highlight of this question is how to split the semi-variable into fixed and variable. And then what all are the requirements of the question you need to compute as per that. Like in this question, we have to calculate the difference between the actual and the budget. All right. So I hope no doubts coming forward. So let us move further. Okay, now we are basically starting with the functional budgets. Flexible budget, of course, we have done the flexible budget. And in one of the questions, we have done the overheads budget also, selling budget, administration budget. So now we will be, in between, we'll be understanding the different types of budget also, and then illustrations also, so that you understand how we approach the question. So sales budget is what? It's the commencement of budgeting. We actually start with sales forecast. So sales forecast, why I have started with sales budget? Because we start with sales. Okay, this much sales we have to do in the coming year. Now, if I have to sell 10,000 units, now then how much production we have to take? So we will find out the production. We have to find out how much capital I should have, how much working capital I should have, how much raw material should I purchase, how much semi-skilled, skilled or unskilled is the particular type of labor I should require. So, sorry. So the starting point is the sales. How much sales I'm expecting to reach, or how much sales I'm expecting to project for the budgeted period. Accordingly, we basically calculate the whole different types of functional budget. The quantity which can be sold may be the principal budget factor. So it gives us the direction that, okay, if this much quantity can be sold, then this much production we have to take. For that much production, this much capital should have. For that production, this much raw material should I have. So sales is the starting point. The sales budget, what it all includes? The quantity of the estimated sales, because the quantity is most important thing. Expected selling price per unit. At what price per unit we are expected to fix the selling price. Okay, in estimating the quantity of sales, past sales volume are very, very important to forecast the sales for the future. How much sales we actually managed to reach in the past. All right. So that is the base for projection for the future. These amounts are adjusted, increase or decrease for factors that affect the future sales. So let us say the past sales was 10,000 units. Now, how much should be the future will depend. Let us say if there is any, let us say COVID was there. So of course the projection must be less than the past. So it depends upon, like, let us say the economy is expected to boom, or there are some positive or favorable factors that can be projected, so that because of that sales can increase. So we will make a higher estimate. So my future projection for sales is going to affect due to, let us say, backlog of unfulfilled sales orders. We could not fulfill the sales orders in the past. Now we have to fulfill. So that sales is going to increase this year. Planned advertising and promotion, expected general economic conditions, productive capacity. If we are increasing our productive capacity for the next year, sales are going to increase. Projected pricing, market research, product profitability, competition. So there are many factors which can influence the future projection of the sales. And yes, the base is the past year sales or the past many years sales. All right. Yes. Okay. Dhyanish, yes, the foreman is not, Dhyanish is asking for this question. Yes, because it is overspent. So the foreman is not entitled to the question. Actually, we were expected to answer Do you agree with the works manager? Foreman entitled to any bonus? No, foreman is not entitled to any bonus. Why? Because there is no saving. The actual was greater than the budgeted, so there was no saving, there was overspending. So the foreman who was claiming the bonus is wrong. Foreman is not eligible for any bonus. All right. So now let's again move to the sales budget we were discussing. So that is the sales budget. I hope you have understood. Generally, in many organizations, sales budget is the starting point for all types of budget. Yeah. So the sales budget may be prepared in the following classification. Sales budget can be made for different products. So product wise, it can be made. It can be made area wise. It can be made salesman wise. It can be made customer wise. So it can be made period wise also. So sales budget can be made under these types of sales. If you can see here in this format, the sales budget is made region wise. So northern region, how much will be the sales and the quarter. So for northern region, how much will be the sale for the first quarter, second quarter, third quarter, and fourth quarter, and the product. So product wise, quarter wise, and the region wise. So last year sales has to be there in a sales budget because it gives you the basically the direction, the base of for the future year. Budgeted year total. So how much should be the total? Budgeted year total means northern plus southern plus central. So the total of all three is the budgeted year of total of sales we are expected to reach. So we can make this format depending upon how the management wants the information. If the management wants the sales budget region wise, we can make it. We can make product wise also. We can make customer wise also. For government, we can make a different sales budget for export, for domestic, for retail, or for month wise also. All right, quarter wise also, week wise also. So it depends upon how the management wants the information in the budget. So accordingly, we can make and we can change the sales budget. So I hope you've understood this. Then production budget. So generally after sales budget, now that we know that, okay, this much units we are expected to sell. How you are going to sell? You have to produce them. So then the second step generally is the production budget. So how much we are supposed to produce so that we can sell that much of estimated units in the future. So once we have the sale, we should prepare for production because we have to produce, we have to do the production only, then we are going to sell the required units which we have estimated. So the next step is the production budget. It's the forecast of the production for the budget. So it is prepared in two parts. Production budget, production volume, physical units, and the cost of production. So first of all, units, how much units to be produced and how much has to be the total cost of production. We take the material, labor, and factory overheads. All right. So direct cost and indirect cost. So we have the units also and we have the cost also. So production budget encompasses two factors, the units to be produced and the total production cost that has to be incurred. All right. So production budget shows the production is based upon sales budget. First of all, our base is the sales. How much sales is expected to be done in the future? Then production capacity. Do we have that production capacity also or not? Accordingly, production budget is made. Increase or decrease in finished stocks. All right. And then policy, of course. So the policies are always there. We have to cater to. Production budget is normally stated in units of output. Production should be carefully coordinated with sales budget. Budget is very important to make the production budget because production and sales are to be in balance. So let us say if the sales are 1 lakh units and we are making the production budget for 30,000 units, there is no balance between production and sales. So we have to make the production budget keeping the base as the sales budget. The number of units to be manufactured to meet the budgeted sales and inventory for each product is set forth in the production budget. So let us say if I have to make a sale of, let us say 10,000 units. All right. And I have already the stock of 2,000 units. I've already have the stock of 2,000 units. So the estimated sale is 10,000 units
and I already have the current stock of 2000 units, that means I have to do the production. If there is no closing stock, I have to do the production for 8000 units. So production budget is made based on the sales and the inventory I have. I'm repeating, production budget, the base of production budget is how much sale I'm going to make in the future, and for that, how much inventory I already have. So this stock I already have. So how much fresh production I have to make. Clear? So that is the production budget. Production budget tells us the fresh production we have to make, keeping in view how much stock I already have. So I already have 2000 units in inventory. So I should make the budget for next 8000 units. That is the shortfall. All right. I cannot make the production budget for 10,000 units because I already have the inventory for 2000. So production budget, two things are important: budgeted sales and inventory needs also. So we take care of the stock also, which we have. Clear? So that is the whole scenario of the production budget. Okay. So this is how the production budget, the components are. See, the budgeted sales. So sales are most important. Then the desired closing stock. If let us say we have any closing stock also with us, let us say we are expecting that there will be these many units left at the end of the period. So that is again the closing stock, the total quantity is required. And this already stock we have. So this much unit should be produced, which should be the fresh production. Clear? So this is the format of the production budget. The sales plus the stock which we are expecting to keep in for future also. Some stock we also keep. And then this is the total quantity we should have. How much quantity we already have. So balance we have to produce. All right. So we go basically backwards. Sales plus closing stock minus opening stock, we get the production to be done. Any doubts so far, students? Clear? So that is the format of the production budget. Plant utilization budget. Plant utilization budget in terms of working hours. Plant utilization budget means how many budgeted hours we are expecting to utilize in the, how many machine hours we are expected to be there, how many labor hours or semi-skilled labor hours or skilled labor hours or unskilled labor hours. So how many hours or how many weight or how many units of the plant we are expected to utilize. So plant utilization budget, that means how much capacity of the plant we are expected to utilize in the future. If the current running capacity is 70%, how much plant utilization is expected? Again, the base is the sales and the production. Clear? So accordingly, plant utilization budget is made. And again, plant utilization budget is the level of activity which can be expressed in terms of hours or units or any other weight which is relevant to that organization. All right. So the main purpose is basically to determine the load on each process, cost or groups, to indicate the process or cost centers overloaded, so that the cost center should not be overloaded. How much working overtime or how much production capacity we need to expand. So plant utilization budget is very important after we make a production budget. All right. You will understand better when we'll do the solutions. Direct material usage budget. So students, when the production budget is clear that, okay, this much units of production we have to produce, accordingly, we have to make the direct material consumption. So if, let us say, 1 kg of raw material is used in 1 unit of output, 1 kg of raw material in 1 unit of output. So I should know how many kgs of raw material will be required. So direct material usage budget can be made only after production budget is made. And production budget is made generally only after sales budget is made. So see, every budget is interrelated. You cannot just see that, okay, we will only make the sales budget, we will only make the production budget. No, every budget is dependent upon any other budget. All right. So direct material usage budget will tell us how much quantity of raw material we require to produce that much of output. All right. So that is the direct material usage budget, the significance of it. The quality standards are specified. So how much of size of the quality material, quality of or color of. So everything is specified in the consumption budget. Requirement of each item of material. All right. That is the main part. So the standard along with the standard quality based on the past performance and test runs, and standard prices of each item of material should also be set. So after quality, quantity, and prices, material cost budget is prepared. Yeah, so this is how we make the direct material usage budget, consumption budget. So this will look something like this. Okay, have you understood? Very good. Yeah, so usage, this is the usage budget. So once I know that, okay, this much production to be made, now this much raw material has to be consumed. So 12 units per finished product, the raw material X is required. The direct type of material, this is raw material. Product A, in product A, so type of material will be X and Y. So in 4,000, these are this production will come as per production budget. All right. So production budget, it has given us the units that 4,000 as per production budget, product A, 4,000 units of product A has to be manufactured, and 9,000 units of product B has to be manufactured. This information is given by production budget. On the basis of this, we are going to make the direct material budget. So there will be two types of material required for both these products, material X and material Y. So 12 units of material X will be required for 1 unit of 4,000. So 12 kgs into 1 unit of material. So how much will be required for 4,000? 48,000. So 48,000 units of raw material are required to produce 4,000, and for product B, 16,000. Similarly, for product B, material X and material Y. So material X, 48,000 plus 1,08,000 units will be required for this particular production. So these are the units required. Total units of material X required will be 156,000. So this is going to give me the consumption. This much material I require. Now the next step will be how much material we should purchase. For 156,000 units of material X we require, and 34,000 units of material Y we require to produce this much units of product A and product B based on the production budget, right? And material cost per unit also we have. So this will give me the total material usage. So this is raw material consumed, the budget of raw material consumed. If you know the raw material consumed, all right? So this has to be the raw material consumed budget. And now when the actual production will take place, actual raw material will be consumed, then we'll have the actual figures from where we can make a comparison. So this should be the raw material consumption budget if we produce 4,000 units of A. So it's just an example that how we actually calculate the raw material consumption budget. So this should be the raw material consumed cost, RMC, raw material consumption cost should be clear. After this, purchase budget. Purchase, what purchase? Raw material purchase budget. So since I just connect from this only. So if we require 156,000 of X and 34,000 units of Y, then we go to the purchase budget. So this much raw material we require, because this much raw material has to be consumed. So now we have to plan how to purchase this much of raw material. Minimum this much of raw material should be there in the stock, in the inventory. Clear? So economic order quantity, how we are planning to purchase. Economic order quantities, how much to purchase. I am sure you must have done it. Economic order quantity tells you how much to purchase in one order. And the reorder point tells you when to purchase. So how much to purchase and when to purchase. So it's part of the raw material purchase budget, because we have to fulfill the consumption of requirement of 156,000 units of the material X and 34,000 of material Y. So how much to purchase and when to purchase, so that the annual consumption of raw material we need to meet. All right. So students, this is the way every budget is interrelated. Clear? So this the raw material purchase budget, of course, it will be more clear when we will do the question. It's just a pro forma. You can see here. So this much units, we follow the same example, this much units we require and this much is expected to be stored in the inventory at the end of the year. So closing stock we have to maintain. So this much closing stock we wish to maintain and this much we require. So this is the actual consumption and this much extra we should have. Closing stock means this much extra we should have. So total requirement becomes this. How? This is required for production and this is extra we require as a closing stock. So total requirement is this, how much we already have in stock. So balance we need to purchase. Clear? So this we need to purchase and this is the unit price. So this should be basically the purchase cost of raw material. So this should be the budgeted purchase cost of raw material. So this is how we make the budget. So raw material purchase budget, how we are going? We are making the sales. With the so on the basis of sales, the base as the sales, we decide how much production we have to make. Once we have decided the production, then we move how much raw material we require for that production. Once we know how much raw material we require, we plan how much raw material to purchase. All right. See, we are going backwards. We are going from the bottom to the top. Clear? So we are starting with sales and we are moving backwards. So it's a backward planning we are doing till raw material purchase. So generally it should be with the sales only. All right. So students, I hope you are able to understand what I am trying to explain here. So this is the total requirement. This we already have in stock. So the balance units we need to purchase. This is the unit price of raw material which we can buy from the market and this should be the raw material purchase cost. All right. So this is how budget helps us to arrange for the capital and finances also. If I want 3,18,000 for the raw material, I need to arrange also 3,18,000. So it's always better to know in advance how much plus and minus I require. So almost 3 lakhs I require for the next year for raw material purchase. If I don't have this money, I have to arrange it in advance. That is the significance of a budget. It helps us to plan our expenditures. If we don't have the money, it helps us to arrange the money, arrange the capital, arrange the working capital so that the production is not hindered or is not hampered, right? Good. So this is how we do it. All right. So we have this one illustration also. Here we have to make the flexible budget at 85% level of capacity, and we have to ascertain the profit and contribution also. We have to ascertain the profit and contribution also. Prepare flexible budget. So let us try to understand what also is living. Currently, it's operating at 75%. In the past 2 years, see, budgets are always dependent upon the past performances. So the levels of operations, the past 2 years, 55% and 65% for the past 2 years. And now it is currently operating at 75%. So that means data for 3 years are given. 75% is the current and 65 is the past, it's the 55 or the past 2 years. And we have to make the projection for 85% for the next year. Yeah. So direct material, direct labor, factory overheads, selling overheads, and administrative overheads. Profit is estimated at 20%. Falling increasing cost are the increase. Okay, so they are increasing cost is also there. So you have to make for 85%. Clear? So first of all, we have to start with the direct material. See, there is no units. Okay, units are also there. 75,000 units. So that means the first and foremost is the number of units. So units. On top of it, you can just, include this column for units. For 75% is 75,000. Yeah. So I think you can calculate for, so 75,000 if at 70% capacity. So it's very clear. It should be 55,000 for 55%, 65,000 for 65%, 85,000 for 85%. The first step should be the number of units. or the number of hours or whatever the information is given, you should place the level of activity is very clear, that whatever is denoted in the question. So in this question, the units, the production units are denoted as a base. So 55,000, 65,000, 75,000 and 85,000 respectively for 55, 65, 75 and 85%. All right. So this is the way. Now, direct material. First and foremost exercise, you should know whether it's variable or semi-variable or fixed. So let us first find out the fixed proportion. Administrative, 160, 160, 160. Administrative is fixed. All right. Any other fixed you can see? No. Direct material, direct labor. Direct cost is always variable. Direct cost is always variable. You don't even have to check for it. Direct material will always be variable. Direct labor will always be variable. How to do the variable cost? We should find out the per unit variable cost always. All right. So the cost is 11 lakh. The units are 55,000. 11 lakh divided by 55,000. Always calculate the variable cost per unit. Always for variable cost, right? So 11 lakh divided by 55,000. It's coming out to 20 per unit. Now 20 per unit should be constant for every level of activity. 20 per unit into 65. 20 per unit into 75 and 20 per unit into 85. So I think you can safely calculate the direct material for 85,000 first. So 20, first calculate the per unit. So 20 per unit is the variable cost per unit, the raw material cost per unit. 20 per unit is the raw material cost per unit. For variable, calculate the per unit cost. Labor also, calculate the per unit cost for labor. It's 100% variable. 5,50,000 divided by 55,000. You can check with every level of activity. The per unit will continue to be constant for every level of activity. For labor, it's 10. For labor, the per unit variable cost is 10 per unit. So it has to be 10 for every level of activity, right? That is what I'm trying to explain you. So I'm erasing the extra figure so that you don't get confused. Clear? So now, direct material is 20 per unit, direct labor is 10 per unit because they are 100% variable. They are 100% variable. Factory overheads, if you can find out, factory overheads generally are semi-variable divided by 55,000. Okay, so factory overheads are semi-variable. What about selling overheads? Just check selling overheads. 3,20,000 divided by 55,000. Okay, they are also semi-variable because 1 per unit is not constant. So per unit cost is not coming as constant. That's why it's semi-variable. That means there is some proportion of fixed and variable both. So how we split semi-variable into fixed and variable? Now these are factory overheads. Let's first see the factory overheads. These are factory overheads. Difference between the cost is 20,000. 3,10,000 and 3,30,000. Difference in cost divided by difference in units. Difference in cost divided by difference in units. So the variable cost per unit under semi-variable are 20,000 divided by 10,000. It's 2 per unit variable proportion in it. How you split the semi-variable? Difference in cost between two levels of activity and difference in units. So 20,000 is the difference in cost and 10,000 are the difference in units. So 20,000 cost divided by 10,000 difference in units. 2 per unit is the variable cost in it. So just split the 3,10,000. So 3,10,000 split between fixed and variable. Variable is 2 per unit. So 2 into 55,000. 2 into 55,000. 1,10,000. So out of 3,10,000, 1,10,000 is variable. 2 lakh has to be fixed. So and in the semi-variable proportion, 3,10,000 out of 3,10,000, 1,10,000 is variable and 2 lakh is fixed. You can check this exercise for this level of output also, 3,30,000. You can check 65,000, the number of units into 2, that comes out to 1,30,000, that is variable. Fixed cost has to be fixed at 2 lakh. So if you can see, it will come out to 3,30,000. 3,30,000. All right. So this is the way we split between fixed and variable. We calculate the variable proportion and the balance comes out to be fixed. So I hope there should be no doubt how we split the fixed and the variable. All right. I hope this is clear to you. Then only we have to go to the next portion of this question. First of all, it should be very clear how much is the fixed and how much is variable, right? So here, I'm now erasing everything now from here. So it's semi. So under semi, variable is 2 per unit and fixed is, how much was fixed here? 2 lakh. Clear? So 2 lakh is fixed and 2 per unit is the variable proportion. Same exercise you have to do for selling overheads also. Selling overheads also 3,20,000, 3,60,000 is semi-variable. How to split it? Difference in the cost. 40,000 is the difference in the cost divided by difference in units, continue to be 10,000. Difference in cost divided by difference in units, variable is 4 per unit. So in semi-variable also, variable is 4 per unit and the balance, if you can calculate, 55,000 into 4. 2,20,000. So 2,20,000 is variable. That means fixed has to be 1 lakh. So selling overheads fixed should be 1 lakh and variable will be 4 per unit. You just multiply it by the number of units in each level of activity. So you will get the split of fixed and variable. I hope it's clear to you. Yes. So 2 lakh is the fixed in factory overheads and 1 lakh is the fixed proportion in selling overheads. All right. Rest now we will understand and we'll take the question forward how we have to do it. Any questions, any doubts so far how we have split it? All right. Now, since we are ready with our variable proportion and the fixed proportion, now let us make the budget for the 85% capacity. Direct material, we again starting with direct material, 20 per unit. So 20 per unit is direct material. Now, see the homework, the working note, the background, the groundwork we have done. Now we will be calculating the cost for 85,000, that is 85% capacity. So we have the variable cost per unit for every level of cost. Clear? So 20 into 85,000, material cost will be 20 into 85,000. Labor cost will be 10 into 85,000. We have the variable cost. So direct material, direct labor was total variable. Factory overheads under factory. Okay. First thing, they have to increase it also. The following increases in cost, we have to take this also in account. All right. So direct material 20 per unit. 20 per unit plus 8%. So first we have to find out the per unit and then we have to increase. So the increase in costs are expected for the next year. So we have to make the increase now. But first we have to find out the per unit cost for variable and the fixed cost also wherever it is fixed. And then only we can increase. Clear? So variable cost was 20 per unit. Increase it by 8%. So 20 plus 8%. It has to be 21.60 into 85,000. We have to give the escalation also for the material cost. Material cost is expected to rise in the next year. So 20 per unit. So first you have to find the per unit. Then only you will increase it. All right. So 20 per unit plus 8%. So 21.60 per unit into 85,000. Similarly, for direct labor, it's expected to increase by 5%. So direct labor is 10 plus 5%. So 10 plus 5%. 10.5 into 85,000. Direct labor has increased by 5%. So 10.5 into 85,000, 10 rupees plus 5%. I hope you have understood this. Students, please do this question simultaneously. I hope you are doing also along with. Factory overheads. Now, factory overheads, variable factory overheads. See, they are seeing variable factory overheads. From here also you can find out that factory overheads were semi-variable, because in the question itself it's given variable factory and fixed factory. That means factory overheads were semi-variable, right? So variable proportion of factory overheads was 2 per unit, which we calculated, 2 per unit. So 2 plus 5%, 2 plus 5% is variable factory overhead. 2 plus 5%, 2.1. 2.1 into 85,000. This is variable factory overhead. Variable. First, we have to do the variable proportion. All right. First, all the variable costs we will take. So direct material was variable, direct labor was variable. From factory overhead, we have split between variable and fixed. We will take variable first. So variable factory overheads, we found out 2 per unit. We will increase by 5% as the costs are expected to increase. So 2 plus 5%. Variable selling. Variable selling was how much? We calculated 4 per unit. I suppose variable selling was 4 per unit. So 4. Variable selling was 4 per unit. So 4 plus 5%. So 4 plus 5%, 4.2 variable selling. Clear? So 21.6 direct material, 10.5 direct labor, 2.1 variable factory overhead, 4.2 variable selling overhead. Clear? We have taken first all the variable proportion of the overheads. Clear? So all the 4 variable we have taken. Now we will take the fixed proportion. Fixed factory was 2 lakh, we found out. 2 lakh was fixed factory. And fixed component should always be in total, not in per unit. You should avoid calculating fixed overheads in per unit. Variable, you should always calculate in per unit. Fixed should remain in total only. So fixed what? 2 lakh. Fixed factory overheads, we split and it was 2 lakh. So fixed factory increasing by 10%, I believe. Variable selling was, 1 minute, variable selling was 8%. Variable selling was 8%. So 4 plus 8%, it's 4.32. Variable selling was 8%. Fixed factory was 10% increase. So 2 lakh plus 10%. 2,20,000, 2,20,000 fixed, 2,20,000 fixed factory. 2 lakh we found out fixed factory and plus 10%, 2,20,000 fixed factory for the next year. Fixed selling, selling fixed was 1 lakh, expected to increase by 15%. So fixed selling is 1 lakh plus 15%. 1 lakh plus 15%, 1 lakh 15,000. So fixed factory 2 lakh plus 10%. Fixed selling was 1 lakh. We found out 1 lakh. We split. When we split, we found out fixed was 1 lakh. 1 lakh plus 15%. Administrative overhead was totally fixed, 1,60,000. Still, it's expected to increase by 10%. So administrative 1,60,000 plus 10%. All right. So this whole the proportion we have got. It's 1,76,000. So now we have all the proportion. Total cost estimated. In which type of question? Danish, it's given in the question itself, the last line. Flexible budget. We are making the flexible budget. It's very clear. See, whenever we make a budget at different level of capacity, it's always flexible budget. I'm repeating. See, this budget, 55%, 65%, 75%, 85%. So this budget is going to be made for different level of activity. It's the flexible budget, right? So it's all, otherwise also it's given in the question, the last line, that you have to prepare the flexible budget, right? So for 85%, we have the ready figures with us. Direct material 21.60 per unit, direct labor 10.5 per unit, variable factory overhead 2.1 per unit, variable selling overhead 4.32 per unit. So variable proportion is over, and variable proportion should be denoted in per unit first. Now comes fixed. Fixed factory 2 lakh was fixed, 10% is expected to increase. Fixed selling, 1 lakh was there, 15% is expected to increase. Administrative overhead, 1,60,000 was there, and 10% is expected to increase. So we have the variable cost and we have the fixed cost with us. To all these costs, so variable plus fixed denotes the total cost. To this total cost, you have to add the profit. You have to add the profit. All right. So cost plus profit, you will get the sales. Clear? So flexible budget, where you have to calculate the profit also, if you can see the last line, and the contribution. So profit, how you will calculate? How you calculate the profit? I'm just erasing it off to just explain it. So here you will have so in this statement, you have the variable cost, you have the fixed cost, right? So you will get the total cost. So this is the total cost. Then you will add the profit and you will get the sales. Clear? So variable cost has 4 components of variable cost in this question: material, labor, factory, and selling. The 4 variable, and we have 2 fixed, 3 fixed. So fixed cost, we have 3 components: fixed factory, fixed selling, and administrative. So it will make the total cost. To the total cost, we'll add the profit, we'll get the sales. Here. So that means the first thing, profit we have ascertained. Then contribution. What do you understand by contribution? You must have done marginal costing by now. What do you mean by costing, the contribution? Sales minus variable cost. So you will find out the sales from here. Variable cost you will pick from here. So sales minus variable cost will give you the contribution. So that will complete your all the solutions and the questions. But before that, you have to complete the whole format of it. All right. So any doubts so far? Clear? Variable cost, fixed cost, total cost, add profit now here. First thing, profit is estimated at 20% on sales, but you have to calculate on cost. Clear? So I hope you must be familiar with how we calculate. Can anybody give me the total cost so that I can just explain how to calculate the profit? I'm just erasing the extra things now. You must have understood. So that I can explain you how to do it. Can anybody give me the total cost? Total cost, variable cost plus fixed cost. Anybody can give me the total cost? Anybody can give me the total cost? 14,57,300 is the total cost. 14,57,300. Is it the total cost? One of you, another student, just confirm before I calculate the profit. So total cost 14,57,300. Total of variable into. I'm taking it as the correct amount if there is no other answer. Total cost. Okay, 37. Okay. The total cost somebody has given me. 37,85,200. 37,85,200 total cost. So I'm just I'll just write it over here also so that there is no confusion. Total cost which I'm getting is 37,85,200 is the total cost. To that I have to add the profit. 37,85,200 profit is 20% on sales. 20% but on sales. But I have to calculate on cost. Cost is, of course, it should be less than the sales. So it can be done 20 by 80. 20 by 80 means it should be 1 and 4, 1/4, right? So if it's 1/5 on sales, it has to be 1/4 on cost. So it's 20 by 80 you can take here. So now you will be calculating the profit 37,85,200 into 20 divided by 80. Can anybody tell me the profit? Yes. Okay. So if it's 20% on sales, it has to be 25% on cost. So students, you should be familiar with how to calculate, because generally profit will be given on sales, but you will be calculating on cost. Most of the question comes like this. So you should be very clear. If it's 20% on sales, it should be 25% on cost. How? Because this is the cost. And cost in this question will be 20% less than the sales. So that means if sales is 100, cost has to be 80. So 20 by 80, the profit should be 9,46,300. 9,46,300 should be the profit. You add the profit to the cost, you will get the sales. Clear? So this is how we do it. Yes. So 9,46,300. So cost into 20 by 80. Because cost is 20% less than the sales in this question. So 9,46,300 should be the profit. Let me show. Okay, the solution is also here. Just take a note of the solution. See, this is the cost we have. This is the profit we calculated. And cost plus profit, you get the sales. How you calculate the contribution? Sales you have, variable cost you have. This is the variable cost, right? So sales is 47,31,500 minus 32,74,200 is the variable cost. This is sales minus variable cost. You will get the contribution 14,57,300. So this is the contribution you have got. Any doubts, students, you can ask. I hope I'm able to make you understand. So we have done a couple of questions of flexible budget. We have done the overhead budget. We have another session for budgetary control tomorrow, where we'll be discussing the rest of the budgets and many numericals, many budgets we are going to make, many different types of budgets we are going to make. So I've gone very slow in this session so that you understand the basics of budget and what are the basic requirements, especially split between semi-variable. And again, how to approach the question is half of the work done. If you have understood what is expected to compute, then only it will be clear. All right. Because in costing, that is the main challenge. You should understand how you have to calculate what you have to calculate. So if you are very clear in your mind how you have to calculate, then the approach the question becomes very easy. Right. So contribution we have calculated, sales minus variable cost, and we have calculated the cost, we have added the profit. And again, as I said, 20% of sales, 25% on cost. Generally, profit is denoted as a percentage on sales only, but we have to calculate on cost. So this is how we do it. So that is the contribution. So I think that's enough for today's session. We'll be covering the rest of the budgets in the next session for budgetary control. And any doubts, I think we will be sharing this PPT with you so that you have the solution and a lot of practice questions for you. So happy learning, students. And I hope, again, see the main stress should be on the concepts and the fundamentals. All right, because in that way, you will be able to approach the question, even if it's a different question, if the concepts are clear, you'll be able to approach it right and solve it right. All right. So enough for today. See you in the next session of budget and budgetary control. Thank you for today. Happy learning.